Hey everyone, welcome to this live webinar. So, my name is Adam. I'm the co-founder of the Fifth Person, and tonight I have with me Mr. Tay Jun Hao, who is a fund manager for the Heritage Fund at Swiss Asia Financial. All right. So before we begin, just want to make sure that you can see my face, hear my voice, and if you can, just type yes in the chat box, and we'll start really soon. All right, Ben, Vincent, John, Brian, welcome. Oh, welcome to the show. So yes, you can see my face and you can hear my voice. Let me introduce Jun Hao as well. So Jun Hao is with us all the way from London. All right, I hear it's really cold over there. All right, and he's going to be covering the Singapore property market and a bit about Singapore banks as well. So we're going to go through a slideshow presentation, and we're going to have your questions that many of you have submitted before this webinar came on tonight. So we'll go ahead and handle those questions as well. All right. And if you have any questions as well, you can ask them in the chat box. I think with that, let's get going. So let me just move on to my slides over here. And Jun, are you ready?
Yep, we're good to go. Let's go, Adam.
Good to go. All right. Let me just share my screen. And let's go.
Right, so I'm gonna get the ball rolling with a short introduction about myself. I am the manager of the Heritage Global Capital Fund. Been running the strategy for about 5 years now. And without further ado, let's actually dive into the content of the presentation today. So just before I begin, we just have our usual disclaimer. Adam, next slide, please. So this is just purely for educational purposes. These are my own opinions, and I always recommend that you do your own research before investing anything. So next slide, please, Adam. So I just want to really set the stage before I dive into the banks, because I think there's been a lot more interest in the stock market in the last couple of months with the STI finally breaching the 3,000 mark again. And I just want to kind of rewind back about 2 years ago. And this was the article actually 21st December 2015 on Bloomberg. And for those of you who remember 2015, you remember it as the year that the Chinese stock market bubble really went out of control, and then it burst in May, June of 2015. And the fall really affected the rest of the Southeast Asian markets as it became apparent that there was an economic slowdown in the region. And if you look at the date of the article, this is 21st December 2015, you can see that the Singapore stock market had already done quite poorly. And in fact, I never really forgot this article headline because it actually compared our stock market's performance to that of Greece. And I was in Europe that time, so I was aware of the situation that's happening in Greece. Youth unemployment is very high. The situation was deteriorating very badly. And even though Singapore was undergoing an economic slowdown, it looked nowhere near as bad in terms of the economic picture, in terms of the employment picture, in terms of how businesses were doing. But here we go. The Singapore stock market was doing extremely badly. Next slide, please, Adam. So bear in mind that this is actually what happened in the next couple of months after the article came out. So the STI was about 2,850 points. And after what happened in January and February of 2016, there was a huge scare in the stock market. The Chinese stock market sold off on the first day because they triggered a circuit breaker, and the rest of the markets got affected. Oil prices literally collapsed in the 2 months that followed, and the STI fell all the way down to about 2,500, 2,550 points. So at this point, you can just imagine the situation. People were really pessimistic in December of 2015. And 3 months later, the STI had fallen another about 10, 15%. So if you look at the peak to bottom decline, if you had been an investor somewhere in maybe March or April of 2015, by the time you came to 2016, you were down close to 30%. And bearing in mind that a bear market is actually considered a peak to bottom decline of about 20%, this was something that was quite dramatic. And if you look at the time frame in which it happened, it was quite quick and quite sudden, and caught a lot of people off guard. So this is the stage in which we're set, in that there was a lot of pessimism, there was a lot of fear. And even in the months after that, even though the STI rallied back to about 2,800 points, people were still extremely worried about the banks, about the oil and gas sector. And we're going to talk about that next. Next slide, please, Adam. So if you look at what's been happening in the market, because I had a couple of questions, quite interestingly enough, asking me whether how valuations in Singapore, is this rally sustainable? Why is the STI at 3,100 points for no apparent reason, really? But if you look at the situation, if you look at, this is the historical price to book chart of the STI. And what a price to book chart just really shows is that relative to your net asset value, how expensive or how cheap are you? So if your house is worth $1 million and the price of the company which owns the house is $1 million, the price to book is 1. If the house is worth $1 million, but the company which owns the house is only worth $500,000, your price to book is 0.5 times. So naturally, the cheaper the price to book is, the more undervalued it typically is. And if you look at the STI, you can see that around 2016, you had a one standard deviation move from the average. And that normally signifies that prices are reasonably cheap relative to historical valuations. And a one standard deviation move is very uncommon. The only other time it's happened within the last 10 years has been 2009, when you saw the STI going from extremely overvalued, 2 times book value, to less than 1 times book value. And if you can look at the chart, there's some evidence to show that this rally is really not a rally into optimism. It's not a situation like in 2009 where people are swinging back into optimism completely, but it's really a situation where prices had gotten extremely cheap and they simply became less cheap, because by historical valuations, we're not anywhere near expensive valuations for the STI. So having set that kind of stage and establishing that the STI was really extremely undervalued prior to the rally late last year and continuing into this year, now let's look at what's driving this rally. Next slide, please, Adam. So this is from a Bloomberg article quite recently, actually. I think this one was in March, and it just shows that the main driving force of the STI's rally so far has been a couple of things. Capital goods, which refers to companies like Capital Corp. So these are companies which manufacture things which other companies use. So you have things like oil rigs, ships, etc., etc. You have the real estate component, which we'll be talking about shortly, and the banks. So today, we're not going to really talk about the oil and gas cycle. We're going to talk mainly about the real estate cycle and the banking sector. Next slide, please. And the reason why I want to talk about Singapore banks in general, next slide, please, Adam, is that they make up a huge chunk and a huge portion of the STI. They make up the main bulk of the STI, really. They make up more than 30% of the STI. So if you happen to buy a STI tracker fund, or you buy a unit trust, which focuses its concentration in Singapore, and you look at the overall concentration, UOB, DBS, and OCBC make up a huge portion of the STI. So understanding what's happening within the banks is quite important in my view. And if you look at the business angle too, just by understanding what is happening within the banks, and also taking into account that Singapore is a relatively small economy, you actually get a good reading of the situation for businesses, for SMEs in Singapore, for what MNCs are happening, and which sectors may be undervalued or in distress, and which sectors may be prime in that there's a credit-fueled growth within the industry. So I find that looking at the 3 Singapore banks is very helpful. And this is something that I find particularly useful in Singapore, and also relevant in maybe the US or China, simply because these are much bigger places. And reading the annual report of one bank may not give you a good idea of what the entire economy is undergoing. The second reason I want to cover Singapore banks is because until very recently, the valuations of the 3 Singapore banks were actually close to that of 2008. That happens every day. Next chart, please, Adam. So this is actually from I think for those of you watching now, you soon see that I like to use articles that were taken at the snap point in time. Try to remove the hindsight bias. And this was actually an article when oil prices were collapsing and there was a lot of fear within the oil and gas sector. and of non-performing loans within Singapore. If you look at valuations in Singapore, it compared 2008 to 2016. Now, other than DBS, which was significantly cheaper in December of 2008, if you look at UOB and OCBC, which traditionally have traded at a higher valuation than DBS, these two banks were actually trading at valuations at or even cheaper than that of the worst moments in the great financial crisis. So that was really, I think it kind of reflected how investors thought the severity of the crisis is. And if you look at the report of 2008 and you look at what Chairman Wee Cho Yaw kind of said about the crisis in 2008, he said this was by far the worst economic crisis he had ever seen in his life, of his entire life running UOB. And you kind of impute that and you take that and you look at valuations in 2016, investors were saying that the current economic situation was so bad that it reflected the conditions of 2008. Now, that's not something I agree with, but that is what the market thought at that point of time. Next slide, please, Adam. So since then, there's been a world of difference. Oil prices have actually gone up meaningfully. If you look from peak to bottom, they've actually rallied 100%, giving quite a lot of relief to people who are in the oil and gas sector. Adam, can you click this slide twice, please? So you've actually seen a meaningful amount of restructuring in troubled sectors in these three banks. And by troubled sectors, I really mean the oil and gas sector in particular. Now, if you look at the bigger global economy, you can see that in 2016, China actually injected a lot of credit into the system. And the situation in China is not as dire as it was back then. So if you kind of look backwards a year ago, you see that a lot of people are talking about a hard landing in China. You don't really see this conversation anymore. And in fact, in the latest copy of The Economist, you can actually see that, they're saying that if you look at the growth situation in many of the emerging markets in China, it looks a lot better than it did 1 year ago. Even if you look at Europe and the US, the situation just seems better. Now, part of this is in reflection, and everything in life is relative, right? Even though oil prices have gone up from 26 to 50, you also have to kind of bear in mind that they did fall from $100 to $50. But it's a relative experience. Since they hit the all-time lows to the current price now, people simply feel better that things are not as bleak as they thought it was. Next slide, please, Adam. But I don't want to downplay the severity of the situation about the banks. If you look at the non-performing loan ratio, I'm just going to use DBS as an example, and this situation is really reflective of UOB and OCBC too. You'll see that non-performing loan ratio, the non-performing loans are increasing, write-downs are increasing, and recently Esra just filed for Chapter 11 in the US. To seek protection against its creditors. So I think that process is ongoing, and we shouldn't fool ourselves to think that the worst is behind us. Next slide, please. But at the same time, the Singapore government is actually quite active. I'm not going to run to all the things it's doing, but you can actually see about two things happening. Now, if you look at the history of the Singapore's government intervention, they do intervene, but they don't want to create a situation of moral hazard. What does moral hazard mean? Now, if they always intervene when it looks like business conditions are not that good, people will then start thinking, hey, if the situation is bad, then the government's going to step in and then we'll be okay. And that takes away the risk from business owners. And they need to intervene in a situation where this doesn't happen. And they do tend to intervene. I'm going to talk about this in the property cycle cooling measures too. When the situation starts spilling into the unemployment increases, you have a situation where the entire industry is jeopardized as a whole. And the thing is, if you look at capitalism, the process of recovery really involves companies declaring bankruptcy. You have the removal of supply from the system. And that's what creates the recovery process as all companies are weeded out. And the capital from these firms is actually redeployed into other firms. So that's the natural process of capitalism. Capitalism is not a one straight line trajectory. You have your boom cycle and you have your bust cycle, and that's a very normal part of the process. By this point, the government has kind of decided it's time to intervene, and you see that they're actually stepping up they're pushing liquidity back into the system and giving breathing space. Still, I think you still see firms collapsing and restructuring in the next coming years. Next slide, please, Adam. And if you look at this slide, you can really see why, if you're a business owner in 2015 and 2016, you can see why it felt so hard in 2015. Post-Great Financial Crisis, in 2010 to 2013, you really had quite a significant loan growth with all three banks firing. Part of this was from the oil and gas sector, of course. And the other big sector which really received a huge transfusion of capital via loans was really property development and construction. The government, after it had its worst showing in 2011, decided that they needed to ramp up public housing supply building. The private sector also responded. And as a result, you saw a huge amount of loan growth within Singapore internally and not going out of the country. And 2015, you really saw that banks started to pull back as they started to see loans go sour, commodity prices were falling, the oil and gas sector was under distress. So that's when you see that loan growth really pulled back quite dramatically. And if you're a small business owner, you could feel that credit was actually quite tight. So now we kind of look at 2016, you see that if you read the comments, I think OCBC is probably the most bearish out of the three banks. But if you look at DBS and UOB, you can see that they are now a little bit more cautiously optimistic. They predict that loan growth is going to maybe grow at single mid digits, hopefully, to the upper range of things. And you can see that credit is slowly moving back into the system. And at the same time, the government is also easing a lot of cooling measures. And we'll talk about that briefly, but this is the picture that's happening. And that's why I think this year you'll find that businesses find it that the situation is stabilizing. Again, this is against a backdrop of very, very dire economic situation last year. Next slide, please, Adam. So I just want to wrap this part of the presentation up. So these aren't actually my comments. This is actually a transcript from Wee Fai Lee, which is the CFO of UOB. And this is in relative, I just want to answer this first because a lot of people ask me about oil and gas sector and Ezra. I just want to raise one point. Number one, I think by this point of time, if you're invested in the oil and gas sector or you're invested in bank, you will know about the distress within the industry. And a lot of the fears about the industry have been priced in. Now, for example, if you're a bondholder in Swiber or a lot of these distressed firms, you have taken the hit or you're about to take the hit. So a lot of this news is not new news. And this is part and parcel of being in the banking industry. But as he says, what I think the big thing about 2016 is that the shocks, if you look what he says that the big names have been taken off. I think the troubled names, everyone kind of knows who they are, and the shocks that have come in 2016 have been taken in. Now, once that happens, once you have an industry that is under distress, there will be provisions, there'll be new non-performing loans, but that's what they normally do at a normal bank. This is part and parcel of the banking industry, that you have to set up provisions and that you're always going to have bad loans. There's no such thing as a situation where you're lending customers and everyone pays you back. So I think this is a normal part of the banking process, and it's not something that I worry a lot about now that it's been priced in. Next slide, please, Adam. But I think what he said, which I completely agree with, was the sudden chunky nature of what happened in 2016, the sudden drop in oil prices, the sudden shift in sentiment, and that really caught a lot of people by surprise. Because imagine if you need to refinance and then suddenly the market oil prices drop from 50 to 25, if you're a potential bank or you're a lender to these firms, you will suddenly feel scared, because if oil prices can fall from $50 to $25, why can't it fall to $12.50 within the next 3 months? And this situation is what really caused a lot of problem in 2016, the chunky nature of it, the suddenness. And if you look at the history of banking cycles and economic crisis, that's unfortunately how things normally work out. If you look at the stock market, I guess taking as an example, you see that it's normally a very nice trajectory upwards, and the drop is suddenly very steep and very fast, partly because of margin. And it's the same in business too. You find that you face business rarely works in a straight line, right? You have a lot of problems suddenly coming on very fast and very quick, but you have to deal with it as a bank. And in the case of UOB, OCBC, and DBS, they are really trying to work through this problem. And I do kind of agree with them at this point. I think OCBC is the most bearish of them. Uh, but I think you can see a rough consensus in that all of them roughly say that, I don't think the situation is over yet, but it's starting to clear itself out. Because think about it, there are only X number of firms within the industry at any one point of time, and it cannot be that every single company in the entire industry is going to default tomorrow. But as you slowly work through the companies that are undergoing restructuring, and more importantly, bankers are acutely aware of the situation, then you can deal with it, and eventually you simply work through the problem. Now, the second part of the equation is, as enough firms restructure or declare bankruptcy, whoever is still left within the industry will start to reap stronger profit margins. They will get more customers as supply gets taken out of the system. Now, when demand comes back, that's harder to say. And if you look at what a lot of oil and gas CEOs are saying, they're saying, we're not sure. We think it's going to be a very long time, right? So I think this is the context within the banking sector. I think someone is probably going to ask me what I think of banking valuations, and the banks have rallied quite hard. I think if you look at the historical valuations compared to now, they're still on the cheaper side of things. Of course, they're not as cheap as they were in 2016. And I think that I personally do not feel, I'm not as worried as I was in 2016 anymore, as a lot of these, as they get a hand of the situation. But I'm going to talk about the second part of it, which relates to the banks too, which is Singapore property. Next slide, please, Adam. Now, the reason why I want to talk about Singapore property in this webinar was simply because if you look at the loan books of banks, the biggest portion of their loan book is actually housing mortgages. The same for UOB, DBS, and OCBC. So what happens in Singapore affects the housing market, affects the banking sector quite dramatically. And if you look at, so this is actually the FTSE ST Real Estate Holdings and Development Index. And again, this is a price to book chart, same analogy that I had just now, but in this case, extremely relevant. You actually see that somewhere along, if you look at 2011, 2012, 2013, you can see that people were quite bullish about property in general. And if you're wondering what happened in 2011, 2012, that was the Eurozone crisis that really took place. But people were generally quite bullish about property for the last couple of years, and valuations were generally quite high, especially post-Great Financial Crisis, as interest rates came down and housing prices crept up. But somewhere along the lines in 2015, 2016, 2017, people started to realize that, hey, cooling measures are working, prices coming down, volume is disappearing. And I remember reading in the newspaper, you can actually see that real estate agents are leaving the industry. They're finding it very hard to work. Some of them are becoming teachers or Uber drivers. And this chart is really just a reflection of the sentiment, because when investors are less optimistic about the future of property, they also tend to, in this case, not reward, but punish these property companies by having a lower valuation. Next slide, please. So if you look at city development, you can actually see that the fall in price was so dramatic. And if you look at the valuations, they actually eclipse the worst of 2009. Now, it didn't feel as bad, because in 2009, you went from close to 2 times book value to just slightly above 0.7 times book value. So that fall in value was quite dramatic. But if you look at the fall in prices from 2013 to 2016, you can actually see that city developments as a company, and if you look at NAV, it doesn't really change dramatically year to year, nor does the business. But you can see that investors thought that, hey, this company is not a good company with a bad part of property cycle. And because of that, valuations are one standard deviation from the mean. Again, I like just to emphasize, if you look at the situation, you rarely see companies trading at one standard deviations from the mean, either on the upside or downside. And when that happens, you have to be very careful, simply because you have to justify on either side of the case why it's so cheap. And so when people talk about the real estate rally and the rally in the property markets, rally in the property market stocks in the property development industry, it's actually not a situation where people are going from bullish to extremely bullish. It's not a situation like in 2009 or 2010. It's just a simple case where people just realize that the industry is not doing as badly as they thought it was doing, and things are looking slightly brighter, maybe not extremely bright. And I guess you can call it a relief rally, of what you call it, but it's not a situation that I am as worried about as if you compare it to 2009 to 2011. Next slide, please. So we've talked about a little bit about property stocks, but now let's actually really dive into the heart of it. What's actually happening within the property cycle in Singapore? And the second question is, would the government further relax cooling measures? Next slide, please. So for those of you who are really interested in property, for those of you who are really looking at this sector, I'm sure that you would be aware of the property cooling measures, which is something that is, which affects the economy, which affects the property market a lot. Now, just kind of relating back to that point again, if you look at Singapore's property market specifically, it's a very niche market, it's a very small market, and it's not hard to intervene with policies from the government. And historically, the government has intervened on several occasions, either to remove cooling measures or to add cooling measures when they think housing prices are too high. And normally, if you look at the historical, when does the government intervene? And they normally intervene when prices dip 8 to 17% from the peak. Today, prices have declined about 11% since its peak in 2013. Now, it's not like previous situations like 1998 or 2008 when prices fell dramatically, but in this case, has been a very, very slow decline, and you're not seeing a lot of distress within the industry like you did back in 1998. Next slide, please. So I think one interesting thing about it was, if you look at what the government had been saying for the last 2 years, and every year for the last 2 years, the property sector has been saying, we need to repeal some of these cooling measures, we need to take it away, it's destroying the sector, it's harming the sector. And every time, the government essentially pushes back and says, now is not the time to unwind property cooling measures. And Taman also essentially said the same thing. And if you look at the aim of the policy, it has actually been quite effective in doing two things. Number one is stamping out speculation. I'm not sure how many of you remember this about 4 to 5 years ago, but you had articles and photos of people queuing up just for the chance to buy property. And that's about as good as you can get to speculation, when you're queuing up just to buy property or for the chance to buy property. And I think the government wisely intervened. They did quite a few things. I'm not going to cover the entire spectrum of property cooling measures here, but one thing which I thought they did, which was quite important, especially when you look at the context of the banks and the entire economy, was to actually implement TDSR. And what TDSR is, total debt servicing ratio, was that it created a restriction on how much you could borrow by linking it to your income. So you had a certain limit on how much you could borrow each month based on the mortgage repayments or the interest payments, and that will be pegged to a certain percentage of your income. And they implemented all this a lot easier than most countries to try to clamp out speculation. But I think also wisely heeding the lesson from 1998, it prevented a lot of people from utilizing ultra low interest rates, which are anomaly, and going out and speculate and borrowing a lot more things. So that's why this time around, I find that if you look at the situation in 1998 and you look at the situation now, there's a huge amount of difference in terms of the balance sheets of consumers, how much money they have borrowed, and how far and how high it has really gone. And if you want to look at a situation where what it could have been if the government cooling measures were not implemented, all you need to do is look at Hong Kong and you can see how crazy the property market has become. And this has even affected the social stability of the country because there's a lack of public housing and private housing is so high that no one can afford it unless you're extremely rich or you're relying on your family's help and money. So I think if you look at it from this spectrum and you compare it to Hong Kong, I think that the cooling measures have actually worked quite well. And they have also kind of fulfilled the backlog of public housing, which they didn't have back in 2011. So on this part, I'm a little bit more optimistic about. Next slide, please, Adam. No, but I think a lot of people are also interested in what the future of the property market is. And this, I'm just going to focus on the residential market right here. I read a lot of articles on Yahoo saying that, you look at, there's still a lot of empty flats, a lot of flats that developers have not sold. Now, just like a store cannot possibly sell everything and it always has to keep some inventory, the same is true of the property markets. And if you look at unsold inventory as a percentage of total housing stock, you will actually find that it's actually on a relative all-time low as opposed to all-time high. And unsold inventory continues to come down. So I think that's point one, which I want to take note of. Next slide, please, Anne. The second thing is that after a bumper year of 2 or 3 years where housing completions have been very, very strong because of prior years, you can see that housing supply actually tapers down after 2017. Like 2018, 2019, 2020, 2021, there's a lot less properties coming online. Now let's just take a step back and think about how property development works. Property development is not like manufacturing a toy or a cup. It's a very long, drawn-out process. You have to bid for the land, to design the project, you have to build it, and that process takes anywhere from 2 to 4 or even 5 years, depending on the size and scale of the development. A lot of the projects you see coming online in 2015, 2016, and 2017 were started in the years 2011, 2012, and 2013. And the paradox of this is that when housing prices are high, that attracts more supply coming in because people see that housing prices are high, and that's also what causes low housing prices as supply comes online. Now, low housing prices then cause a rebound eventually as supply leaves the system. So I think someone did ask me, he's very pessimistic about the property market. He sees developers going to Australia, he's going to China. No one wants to develop property in Singapore. But that is the paradox. That is actually the catalyst going forward into the future as supply gets taken out of the system. So you're starting to see on block sales, you're starting to see that. And if you look at what the government is doing on the right-hand side, you can see that after a bumper year from 2012 to 2014, where they were releasing a lot of land, they're tapering the amount of land they're releasing from the government. And that's one reason why developers are now focusing on en bloc sales again. So this bodes well again for the future of the property cycle. And the idea is really what drives the property cycle. So if you look at office, if you look at hotels, if you look at commercial properties, they are all derived from this cycle. Now, demand is a bit harder to predict, but supply is a lot easier to predict. So if you're sitting down in 2011 and 2012, you could see a huge influx of supply coming in. But the reason why it's harder to work with property cycles in general is simply because of the duration of time. It takes a long time to flow into the system, and that's why people get caught off guard. Now, if you look at oil prices, it's exactly the same phenomenon. You had record high oil prices that spurred a lot of exploration. You had the shale gas, you had deep sea exploration, and that's what also caused the problem eventually as supply overwhelmed demand. And eventually, low oil prices will cause a lot of producers of oil to go out of business, and that's what creates the next wave up. So dealing with cyclical companies involves that process and involves that understanding of it. And if you look at the history of investing in property, the best time to buy property is always to buy property when no one wants it. And no one wants it when supply is high and you cannot fill the house with a tenant. The worst time to ever buy property is to buy when rental yields are very high, when when people are bullish about property and looks like there's no property, because you can be sure that if it looks like there's no supply of property online, developers will be hungry to come in and fill that gap. So with that, I'm just going to end the presentation on the property cycle. So I've covered the property cycle, I've covered the banking cycle. They're intricately linked, and I think we're going to run into the Q&A now, right, Adam?
Yeah, that's right. So thank you, June, for sharing what you know about the banks in Singapore and our property market cycle as well. And now we're going to go straight into the Q&A that many of you have submitted before this webinar happened tonight. So if you have any questions again, you can always put that in the chat box. So I'm gonna exit this. We're gonna go straight to our camera view so people can see us. All right, this is a bit okay. All right, so I think everyone can see me now. All right, so
Yep.
many of you actually have submitted a lot of questions about the property market and Singapore banks and all that, and we're gonna ask Jun some of them right now. All right, so let me go straight to the first one. There's this question here. So, from a value growth long term investing perspective, it is often said to avoid cyclical businesses. So, how do you approach construction and property stocks? What do you think?
Okay. So I think some businesses are generally more defensive, and some businesses are naturally more cyclical. But I really wouldn't pigeonhole it into, you shouldn't invest in cyclical businesses. You should only invest in defensive businesses. And I want to take telecommunication companies as an example, StarHub, Singtel, and M1. Now, I think generally we can all agree that these are more defensive businesses. End of the day, even in recession, you're going to keep your phone line. But even these companies, which work in defensive industries, can also be affected by cyclical forces or structural changes. In this case, it's the government saying, we need another telecom operator. And that's going to impact your profits. It's going to affect your dividends. And you see Starhub has actually had to cut the dividend from 20 cents to 16 cents. So I think it's quite dangerous just to say, only defensive businesses are good. Only cyclical businesses are always bad. So that's always been my viewpoint. And I think that if you look at construction companies and property companies, this is what I like about construction companies. Now, if you look at the history of the government's way of intervening in economy, you can see that they kickstart a lot of public construction a lot of public construction and a lot of infrastructure construction during times like 2015 and 2016. Why? This is fiscal stimulus. And the good thing about construction within Singapore's economy is that the money tends to stay within Singapore. It's a localized thing. You get a big multiplier impact, and you're also building infrastructure at the same time. It's a win-win situation. And that's why if you look at the budget speech this year, you see that they're saying they're bringing forward public construction. Now, consequently, during boom periods like 2014 and 2015, you see that they par back on public construction generally so as to not overheat the economy, not to cause rampant inflation, because there's only X amount of workers within the industry at any point of time. So I think the best time to invest in a lot of these companies is when prices are very low, price to book ratios are low. Same for construction and same for property development firms. The best time to invest in these businesses has always been when things is out of favor. And that's why I've really waited so long to invest in these firms. So to give you an example of how long we waited, we looked at companies like City Developments and all these companies for many, many years. The reason why I've always stayed away, and this goes back to the heart of investing 101. You always want to be looking at assets which are out of favor. You're always looking for distress, but you always want to make sure that you're finding companies which are financially sound and are in a net cash position. And it's not easy to predict the next turn of the cycle, but as long as you have the cash and the balance sheet to withstand the cycle, you're going to come out okay. So if you look at the property companies we look at, or you look at the oil and gas companies we look at, there are always companies with the strongest balance sheets. There are always companies with lots of cash, and the companies which have been waiting. But it's hard because during the up cycle, if you take on a lot of debt, if you're Swiber, you take on a lot of debt, it looks like you're making a lot of money, but you're going to pay one day. So I think with cyclical companies, you always have to focus on that strong balance sheet, because if not, if you're investing in a company with a weak balance sheet in the wrong part of the cycle, you get a situation like Swiber or Ezra. So I hope that answers that question.
All right. So there's another question about banks right now. So what do you think about the long-term prospects of banking stocks with respect to the many ongoing disruptive challenges like fintech, the slow growth environment, low interest rates, higher regulation? Do you think Singapore bank stocks will continue to grow to new higher EPS, or what do you think about this?
Yeah, I think he also had a comment about people trusting bankers less, which I find quite funny, but true. I think Singapore banks occupy a specific position of the economy that's quite different from other banks in the world. If you look at the deposit growth of banks in crises, even in 2015 and 2016, you see that they continue to grow recession after recession. And if you look at the current economic, you look at the current climate, it's a situation like StarHub, Singtel, and M1. It's really an oligopoly. There are only three main players, and it's very hard to take away the competitive advantage that these companies face. Now, are they going to face threats from all these things that you talk about? Yes, I think every business is facing the same ongoing threats. But what they have, which most businesses do not have, is a competitive advantage that is insanely strong, right? If you are the only lender, if you're the only depositor, you have a strong deposit base from a country that likes to save, and most of your loan book is made up of very conservative housing mortgages in Singapore, you have a huge advantage which other banks in the world don't really have. Now, if you look at the amount of fines that HSBC has to pay or Bank of America has to pay, and you look at what has happened in Singapore, you start to see the strong competitive advantage that these banks face. So I kind of agree that there are threats here. But let's say you're OCBC. There's this fintech companies out there disrupting you. It's not making that money as this new technology. If you're OCBC, what do you think? Well, I'll just buy out the company. I'm making a couple of $1 billion a year. If you look at DBS, the quarter that they took the Swiber write down, they still made a couple of $1 billion, right? So that is the amount of money that these companies are making. And I see no reason why this competitive advantage is going to disappear in the next couple of years. Because if you look at the way that the government has really built up the financial sector, the one biggest thing has always been financial stability. So if I tell you, you can put your money into Bank of China and earn 0.2% more interest, will you transfer all your life savings to Bank of China tomorrow? Probably not, right? You're still putting in UOB, especially if you see that there's financial distress all around the world. And that's the kind of competitive advantage they have. Now, digging a little bit deeper, this is also reflected in the FD rates. If you see the FD rates, Maybank and these overseas banks consistently have to give higher FD rates than UOB and OCBC and DBS, simply because they are not local banks. So within the context of Singapore, I think that they still have a huge competitive advantage. Going forward, I think it's really which part of the credit cycle we're at. I think we're at the lower end of the credit cycle. I think that's okay. And I always like to say, if you want to lend people money, there's always a place that people are going to want to take the money and invest in. But it's just whether you can do it prudently and safely and make sure that shareholders also protected at the same time.
Okay. Frederick has a question here. So he's asking, although the government has tweaked the property related measures, he feels that it's too late. Many of our local developers have stopped the government land sales biddings. They have gone overseas into Australia, Cambodia, London. So the transaction volume, home prices, and rent have been impacted for some years now, exacerbated with poor economy and unemployment. So, in your opinion, do you see the property prices continue, to continue to decline, or has it bottomed for 2017?
Okay, I don't know whether it's bottom. I don't want to make a prediction in the next 6 months or 12 months, but as I kind of indicated in the presentation, the fact that Singapore developers are going overseas, despite what people may think, is actually a positive sign for the property cycle going forward. Like I said, with property cycles, you only have demand and supply. Demand is easy to understand and hard to predict because it comes from household formation, it comes from immigration, which I think the government at some point or another, as they keep indicating that they want to increase. On the supply side is also easy to understand because you have public housing and you have private housing. So if you think about it, and also going back to the slide which I showed later, if developers today are leaving Singapore and your existing housing stock keeps decreasing, and you have net migration, you have household formation, and demand slowly eats away of the existing housing supply, that's when prices eventually start to rise. Now, if you have a situation where you have developers coming back and developing maybe twice the amount of land that they were developing last year, you will not get higher housing prices because your demand has not increased by 100%. So in that case, that's why, and you gotta realize these property developers, they also read the news, they get bearish, they're human like you and me. And that's why very, very few people do so well. If you look at people like Li Ka-shing, you look at people, if you look at Far East Organization, if you look at Sinoland, which is a listed company in Hong Kong, you can see that they are also big buyers of land when prices are very cheap. And when prices are high, they tend to sell. So in Hong Kong today, they've sold off most of their land, they have net cash position, they're just waiting to buy land again. So just using and thinking about the principle again, I'm not so pessimistic. I think as long as existing supply does not explode in the next couple of years, I think that eventually the existing supply will get taken out of the system. Now, when that happens is anyone guesses. But as I like to say, on the cycle, this is the part of the cycle which I like, as opposed to maybe 2011, 2012, where you could see a huge wave of supply coming in.
Okay. Wailon has a few questions, so I think I'm going to ask them all together because they're pretty short. So, how does the easing of the property cooling measures affect the physical property market? So, he says it seems to be moving upwards after the easing. What is your view? And then he has a question on the banks because there's still no light at the end of the tunnel for oil and gas stocks. How will it affect the bank's balance sheets?
Yeah, so just to talk about the physical property market, I think if you look at the current cooling measures tweakings, now generally they don't actually do a lot other than I think the changes in the loan to value ratio in stirring up buyer sentiment. I think the general consensus is quite simple. It's not so much this set of cooling measures which have been repealed, but simply that they have started that cycle where you start repealing the cooling measures one by one. Now, if you like history again of the cooling measures and they're implemented and they're repealed, they don't all happen on a single day, but they start to happen in sequence. So I think what people generally, analysts think that, this could be the first sign that the government is finally on that phase where they say, okay, enough is enough. It's time to start repealing these cooling measures altogether. So I think how it affects the physical property market is a little bit harder to say at this point of time, but it's definitely stirred up sentiment somewhat. Now, I think the second question about there being no light at the end of the tunnel for oil and gas stocks, I think there's always light at the end of the tunnel. I think for the last 2 years, for those of you who have been following the situation, uh, all industries eventually emerge from distress, even though it looks like there's no light in the tunnel. And for those tracking the industry, I don't think the worst is over yet. But as UOB's CFO has kind of indicated, I think a lot of the big names people are aware of, actions are being taken. You still might see one or two big bankruptcies and restructurings. But I think the light is not as far as people may think, just because we're tracking a lot of these businesses ourselves, and a lot of them are really engaged in the painful process of restructuring. Now, I don't want to take this lightly because people are losing their jobs in the oil and gas industry, but this is also a reflection of what's happening in the oil and gas industry. You're cutting costs, you're restructuring, you're lowering your cost base by reducing employment. These are all steps which are necessary for the long run survival of industry, and these steps have finally been taken after a couple of boom years in which people thought it will go on forever. So I think a lot of restructuring is happening, a lot of things at the back of the scene are happening, and so I'm more positive for the industry than most people.
Okay, we're gonna ask this one question from Do before we go to the live question. So Do has a question about interest rates. So he has a question about interest rate hikes, and he believes that this is a question that's raised by many investors as well. So although the very recent interest rate hike by the Fed is known to everyone, in most cases it's already priced into the markets. The increasing cost of money itself will have an impact to almost all walks of business fundamentally. All right. What he wants to know is that how do you think the rise of interest rates will affect the stocks pricing, especially REITs and the Singapore property market in the long run in the next maybe 1 or 2 years. All right. So
Yeah.
it's a pretty
So
long question. I think I'll just stop at this point now.
yeah, so I think the general fear that a lot of people have is the rise of interest rates and just generally the cost of borrowing. And I think it's come to a point where, and let me put it this way, interest rates are not the end all be all of economic success and failure. Or if you look at a company like Swiber didn't go declare bankruptcy because interest rates went up by 25 basis points, right? And it's not going to collapse and a firm will not collapse just because borrowing costs go up by 25 basis points. And the problem with having very cheap interest rates, and one thing which the government did wisely, which by implementing TDSR, was that extremely low interest rates and an ample supply of credit create bubbles by creating oversupply, overcapacity, because it's so easy to borrow money. So you have cities in China where they're ghost cities because it's so easy to borrow money. Interest rates are low, you build, but you realize you have no demand. So having low interest rates and cheap credit does not necessarily mean that everything will be good and great for the world. Now, at the same time, if we take it into the context, why is the Federal Reserve increasing interest rates? And if the reason that they are increasing interest rates is because the economy is doing better, unemployment is decreasing, the economy is starting to heat up, increasing interest rates is not necessarily a bad thing. And if you look at the history of the Singapore stock market, you actually find that 2005 to 2007 was actually a great time, even though interest rates were increasing. So I think I don't want to go too long on this subject, but I think the answer is simple. If you invest in a company that is highly leveraged, that is highly sensitive to interest rates, then yes, having interest rate, the cost of borrowing increasing is probably not a good thing, which is why I always say find companies with lots of cash, they don't have too much borrowings. And I think that's always the sensible thing to do. Now, generally speaking, if interest rates rise and the cost of borrowing increases, the biggest beneficiary of these companies, of the interest rates rises, tend to be banks. So it kind of fits into that entire framework which I was talking about. You want to look at it, the whole picture. Now, if you look at interest rate costs when the property cycle was booming in the 1990s, you find that interest rate costs were much higher than they are today. And really, the record low interest rates we have today are a historical anomaly. And for the most part of history, and I read an article recently saying that, you look at Singapore from 1965 to 1985, they were growing 8% per annum. But interest rates were not 1%, we were growing 8% of annum. So I just want to say correlation is not causation. It doesn't mean that interest rates are high means that stock prices will do well. Interest rates are low, stock prices will do well. I think this correlation causation thing gets taken out of hand. But if you were to ask me today, I would say that generally interest rate hikes have already been priced in by everyone because the Federal Reserve has been telling everyone for years that interest rates are going to go up. Yep, so I hope that answers that question about interest rates generally. Yeah.
Okay. So that's what you think about interest rates. So I'm going to ask you some questions from the live chat box that we have, and there's some pretty good ones before we wrap up this live webinar. So
Yeah.
Troy has a question here. So this is what he believes, right? For property to grow in value, the economy needs to grow. So the population needs to grow, wages need to grow, but he doesn't see that happening. What is your outlook on these variables going forward, and what do you think the next growth drivers in the Singapore economy?
Okay.
If you have any thoughts on this.
So I hope I don't sound too cynical when I say this, but if you look at what happened in 2000, on the aftermath of the Asian financial crisis, right? You had an oversupply of housing from overbuilding. Public sector built too many houses. Private sector built too many houses. There was too much outstanding industry, and there's inventory. And this was one reason why I don't know if you guys still remember Minister Ma Baotan. He said, we shouldn't build more public housing, even though everyone is saying there's not enough public. We shouldn't build too much public housing because they were scarred by the last experience. And for those of you that don't remember, what led to the surge in demand was actually the influx of immigrants coming in, which then led to the poor showing that they had in GE 2011.
Yeah.
Now, so you have your natural things like household formation happening, and these are all latent things. But what I think eventually will happen is that migration will eventually increase again, and the government has indicated this again and again multiple times. You have aging population, you have their white paper 2030. It'll be too cynical for them to do it right after the general election 2016 when they said they weren't going to do it. But you can see that they've taken a different step from the last step. They're building the infrastructure, they're developing a lot of public housing development areas on the outer regions. And I think this is just the natural conclusion of the next step, because there is simply no way for Singapore to continue its pace of growth, like you said, with its current existing population, because the average working age of the population is going to decrease. And unfortunately, depending on how you want to think about it, the Singapore government is quite pragmatic in this area. And I would not be surprised if we see a situation like what you did in 2005 to 2007, when migration laws were relaxed significantly and you saw a huge influx of people coming in again. So I think that would be the eventual driver of growth in the market. Just to just add on one point, if you look at the London property market 20 years ago, it was completely dead. And what eventually happened was that they entered the EU, migration came in, people decided, hey, the EU's London's a great place to work relative to where I live, be it Poland, the Czech Republic, and decided to migrate there. And it will not surprise me the similar situation happens in Singapore eventually. And also the fact, hello, Adam? I'm not sure if I'm still live, but yeah, I hope that answers your question.
Okay, okay,
Yeah, I'm not sure if it's
we
your
got
connection
that
has gone dead.
because it's broken up in the last. Yeah, so you're a bit far away. You know, you're halfway, almost halfway around the world.
Yeah, okay, sorry, I'm back. Yeah.
Yeah. Okay. I don't know. Probably missed the last 30 seconds of that, I guess.
Yeah. So I was just saying that, if you look at London 20
Yeah,
years ago,
that's right.
property
Yeah.
market was in doldrums, it was dead. And what eventually happened was that you had a lot of net migration coming in from the EU. And I think, Singapore is a desirable place. A lot of people want to live here. Now, what the immigration policy going forward is, I don't know, but I would not be surprised if the government eventually intervenes if birth rates continue to decline or stay at the low levels they are today.
Hmm.
And given what they're doing with the public infrastructure spending and developing all these things and creating access capacity, I think what happened eventually, when is another question.
Yeah. I mean, um, they always talk about 6.9 million. We're only at 5.3, so still
Yeah.
some ways to go. All right. Grace has a question here about banks. I think this is right up your alley. So she feels that right now that she says, all right, the ratios all three banks right one. So although they are like near to low historical valuations, it does not seem there's a huge margin of if you invest now.
Sorry, Adam, can you repeat a question? You got cut off on my end. I'm not sure why.
All right, okay. Let me just say it again. All right. So Grace has a question. She says the price to book ratios of all three banks are urban it does not seem that there's a large margin of safety at this point in time to invest. All right. So what are your thoughts on this?
Well, I mean, I think if you look at the prices of banks today and in maybe just 4 or 5 months ago, when I'm just going to use the example of UOB, when UOB was trading at 18.50, I think today it's maybe 21.50 or $22. Yeah, the margin of safety has definitely decreased a reasonable amount, and I will not disagree with you. So I think future returns for banks going forward have decreased quite a reasonable amount. I think the margin of safety, you still have some there. I think banks are still a reasonably good investment. But as I always like to say, it really depends on what you want your future return to be. Now, if you're thinking of making 20% a year, let's just say you're thinking of making 20% a year, your dividend yield is 3%. The average price to buy the bank you're looking at has always been 1.5 times, and you buy at 1.3 times. There's no way you can get 20% a year over 5 years. And the only way you can do that is by buying banks at extremely distressed situations like 2008 or 2016. So I think it really kind of falls back into what you think you want your future return to be. So if you think you're making 8 to 10%, which is the STI's return over the long run, then yes, maybe you can consider banks because I think you're still within that range of valuation. So I think that in the context of margin of safety, that's how I would frame it. What do you think you want your future return to be? And then you have to start working backwards from there.
Yeah, so I think it's a personal choice of when you want to go in at what price. It really depends on the individual. All right, so
Yeah.
maybe let's take a couple more questions because it's been almost an hour since we kickstarted this webinar. So maybe a couple more questions before we call it for the night. Is that all right, Jun?
Yep, sure, let's go.
Yeah. Okay.
Yeah,
I
go.
think this
Good.
is this is a pretty interesting question. I don't know if you have a view on this, but I think a lot of listeners would be interested in this one. Mark has a question here, which is: do you have a view on the Johor Iskandar region with regards to property? Yeah.
Yeah, actually, I was just reading an article just yesterday on the South China Morning Post. I will ask Adam to forward it to all of you, talking about the huge offshore development in Malaysia, and I was talking about how they were marketing it to Chinese investors. And the Chinese investors found out that they can't pay for it because of the capital controls. So I think Johor is an interesting situation because I know some people who are optimistic, some people are pessimistic. But let me put it this way, and I'll try not to be too controversial on it. Why would Johor need to reclaim land when it has a vast abundance of land? Iskandar is not really occupied. Vacancy is not exactly full of people. They don't have a massive influx of people that want to stay in Johor Bahru by any measure. And then you have a huge Chinese development offshore reclaimed, in which they're selling to Chinese people and no one else. I think if you put one and one together, I think you will find that you can probably relate it to the policies of the Malaysian government in relation to Chinese people and how they find it unacceptable for a massive influx of Chinese immigrants to enter Johor Bahru and you have to claim it offshore. And I think just looking at the entire project, I guess thing is completely wasteful. I think the current Iskandar is not even filled up itself. And so I don't really have such a strong view on it, but I will be very cautious and very scared because like I said, you go back to that demand supply equation. You have a massive increase in supply from the new development. I think the company in question is called Country Gardens or something like that. You have Iskandar. Where's the demand coming from? So unless, and some people may feel that this is true, but unless you feel that it is politically savvy for the Najib's administration to allow a massive influx of Chinese immigrants into Malaysia in the next 5 years, I am very cautious about the entire development completely because I don't think that is going to happen anytime soon. And for those of you who are very interested, I will read up about the 1MDB and Najib visiting Malaysia. So I think I'll just leave it as that. But I am a lot more pessimistic about that development, just kind of relating back to your demand and supply equation. Where's your demand coming from if your supply is massively increasing the way it is?
Yeah, I mean, I was in Iskandar maybe a couple of years back, and there were like so many developments going on, but it was pretty quiet. So I was always wondering how they were going to fill up the space over there. But anyway, I didn't buy anything anyway. So maybe we'll just do one more question and then we'll call it for the night. MJ has a question here. So, do you have any comments on companies that are downstream of the property industry? You know, like cranes, heavy machineries, stuff like that.
So we talk about cranes. Maybe you're talking about Tat Hong Engineering, Tat Hong. So they lease out cranes and all that. I think generally with these companies in general, you have to be a little bit more cautious, and it really is regards to the specific company. Let me tell you what happened with Tat Hong, generally speaking, because I think it's reflective of what the industry is generally facing. If you buy a crane, you pay for the crane up front, or you buy it on lease, and then you rent it out to someone else, and you earn the difference between the cost of borrowing and you renting it out to someone else. Now the problem is if you buy too many cranes, and property construction goes down, you're still left with the lease payments and the debt which you took on to buy these cranes. And that's the intrinsic problem with Tat Hong, and that's why they had to sell a lot of their cranes to raise cash, and they had to do a very dilutive share issues. So this is just my general comment. So I think generally you have to be a little bit more cautious when times are good. Like again, you borrow a lot of money, you're earning the difference between the cost of borrowing and the cost of renting out the crane. Yeah, there's a problem there. When the situation turns sour, your interest rate goes up, people don't find you credit worthy again, and you can look at the share price chart of Tat Hong to see the outcome of it. So generally, I'm not as positive. And maybe I put it this way: you see a lot of rich property development firms, you see a lot of rich landlords, but you don't see a lot of rich crane owners around the world, and there's a certain reason why. But you see a lot of rich crane manufacturers. Oh, yeah. So I think that's an indication that it's not the most ideal industry to be in relative to the industry that's producing plenty of billionaires. You know, Caterpillar is a great business, but you let the guy that buys Caterpillar products, not as much. So I think that is the general warning sign to me that maybe it's not such a great business. If you take the analogy, sorry, Adam, are you still around?
Yes, I am.
Yeah. So if you look at the same analogy, almost every airline I know is struggling. Cathay Pacific is struggling. Singapore Airlines is struggling. Tiger Airways was struggling. You know, every airline is struggling. That's not a great business to be in. You don't see a lot of multi-billionaire airline owners. But you see that Boeing makes a lot of money selling airplanes. So that's what the hint is, that's where the money is, and that's generally where you want to follow. Yeah, those are just my general comments.
Yeah, so it's
the real estate industry and sector.
All right, so it's kind of like the story of hello, Jin?
Yeah, I'm still here.
Yeah, so it's kind of like the story where instead of if there's a gold rush, you don't go digging for gold, you sell shovels.
Yeah, I think that's a good way of thinking about it. I mean, think about it this way. For many people here on this call, I'm assuming, you know, you're investing, you have your main job, you have your main business, and you're investing. And generally, I think with investing, unless you've decided to be a lot more speculative, it's much better to err on the side of safety as opposed to err on the side of aggressiveness unless you are investing in VC or you know straight away that this is a very speculative investment and you treat it as such. And I think that's just the way I think about it, really.
All right. Okay. All right. It's been over an hour since this live webinar has started. So thank you so much, June, from from joining us all the way from London. So thank you, June.
Yep, no, my pleasure, Adam.
And thank you for all of you watching this right now. You're very, very welcome to join us every month for this fifth hangout that we have, where basically we get investors like Tay Jun Hao, who's a fund manager, or Victor Rusmin from the Fifth Person to answer your questions that you may have. So thank you so much for joining us, all of you, for joining us live tonight, and of course for submitting all your questions as well beforehand and during the live show as well, because without your questions, this show wouldn't be possible. So thank you so much for joining us. Thank you, June, once again. We hope to see you back in Singapore really soon.
Yep.
All right, we'll catch up with
Take
you,
care.
and then thank you for joining us once again. So thank you for joining us. My name is Adam. I'm the co-founder of Fifth Person. Thank you for joining us for the fifth hangout, and we'll see you around really, really soon. All right, so good night, everyone, and see you around, June.
Thank you. See.
All right.